Hello, and welcome back to Explain the Charts, your go-to channel for in-depth technical analysis. Today is September 30th, 2025, and we are taking a close look at the QQQ, the ETF that tracks the Nasdaq 100. First, let's quickly touch on the current news environment shaping market sentiment. Recent reports from the past week indicate some mixed signals for investors. On one hand, there's been talk of potential market slides and concerns over upcoming jobs data, which could influence Federal Reserve policy. On the other hand, we've also seen reports of the Dow showing resilience despite worries about a potential government shutdown. This creates a backdrop of uncertainty, where the market seems to be weighing strong underlying trends, like the AI boom highlighted by NVIDIA's recent surge, against looming macroeconomic and political headwinds. Now, let's see how this nervous but resilient sentiment is reflected in the price action. We'll start with the big picture on the daily chart. Looking at the full daily chart, the long-term story for QQQ has been overwhelmingly bullish since the lows of late 2024. We can see a powerful uptrend characterized by a series of higher highs and higher lows throughout 2025. The market has consistently found buyers on dips, pushing to new all-time highs. However, this uptrend has not been without significant volatility, which is crucial to understand. Let's zoom in on a particularly wild period earlier this year in April to see how quickly sentiment can shift. Here in early April, you can see a brutal sell-off where the price dropped from around 476 all the way down to nearly 402 in just a few days. Notice the extremely high volume on these down days, indicating intense selling pressure. But just as quickly as it fell, look at this massive bullish reversal candle on April 9th on even higher volume. This signaled a powerful capitulation bottom, and the market aggressively bought that dip, erasing the entire drop within a matter of weeks. This event established the 400 to 420 zone as a major long-term support area, a place where buyers showed immense strength. Now, let's return to the full daily chart and focus on the most recent price action. After making a new all-time high just last week around the 602.87 level on September 22nd, the market has seen a slight pullback. This is perfectly normal after a strong run-up and could be interpreted as healthy consolidation. The price has spent the last 5 trading days moving sideways, building a range. The key immediate support level appears to be forming around the 593 to 595 area, where price has bounced multiple times. The major resistance, of course, is that recent all-time high near 603. A break above or below this range will likely dictate the market's next short-term move. We can also see that the volume on the recent down days has been slightly elevated, suggesting some distribution might be taking place under the surface. A more significant area of support to watch below the current range is the 588 to 590 zone, which acted as a ceiling in mid-September before the final push to new highs. Former resistance often becomes new support, making this a critical level if the current range breaks down. Even lower, the 575 area served as a strong consolidation base throughout late August and early September, representing a major potential safety net for the bulls. To get a better feel for this current consolidation, let's switch to a lower time frame. On the hourly chart, looking at the past few weeks, we can clearly see the breakout past 590, the strong rally to the 603 peak, and now the subsequent consolidation. The price is currently coiling in a tightening range, which often precedes a significant move. We're essentially trading in a box between roughly 593 and 600. This hourly view shows us that buyers are stepping in consistently near the 595 level, but sellers are also defending the 600 level quite firmly. A decisive hourly close above 600 or below 595 would be the first signal for short-term traders. Let's get even more granular and look at yesterday's price action on the 15-minute chart. Looking at the 15-minute chart from yesterday, September 29th, we can observe the intraday battle between buyers and sellers. The day started with a push towards the 600 level, but momentum stalled. We then saw a methodical grind down throughout the day, finding temporary support around 597.50 before a final push lower into the close. This intraday weakness suggests that bears have some control in the very short term, and they're actively defending prices below 600. Any bullish attempt will first need to overcome this intraday selling pressure and reclaim levels like 599 and 600. The price action here reflects the broader uncertainty we talked about earlier from the news. So, what's the overall takeaway? Let's summarize the bull and bear cases and the key levels to watch. To recap, the bullish case is straightforward. The long-term trend is undeniably up. The market is simply consolidating after hitting a new all-time high, and this pause could be building energy for the next leg higher, potentially targeting 610 or 620. For the bullish case to gain strength, we need to see a decisive break and hold above the 603 all-time high on strong volume. The bearish case is that this consolidation is actually distribution, where larger players are selling into strength. The failure to hold the all-time high, combined with macro uncertainty, could lead to a deeper correction. For the bearish case to be confirmed, we would need to see a convincing break below the 593 support level. This would open the door to a test of the next key support at 588. So, let's outline the key price levels one more time. Your primary resistance is the all-time high around 603. Your immediate support is the bottom of the current range, around 593 to 595. Below that, the next major support levels are at 588 and then down at 575. Here are my unbiased predictions. There is about a 60% probability that the market resolves this consolidation to the upside, eventually retesting and breaking the 603 high. This is based on the powerful underlying trend, but it will need a positive catalyst, perhaps better than feared jobs data or a resolution to shut down talks. I'd place a 30% probability on a breakdown below 593 for a test of 588. This would become more likely if negative headlines dominate and selling volume picks up significantly. Finally, there's a 10% chance we simply continue chopping sideways in this range for another week. Moving forward, keep a close eye on those key levels we've discussed. Watch for news related to the jobs report and any political developments in Washington, as they are likely to be the primary catalysts. That's our analysis for today. Thank you for watching Explain the Charts. If you found this helpful, please hit the like button, subscribe, and ring the bell so you don't miss our next update.